Hey, what's up, guys? Marshall Sparkman here, VA loan specialist. Wanted to do another quick video on the topic that's very controversial, that I get a lot of questions on, that lenders don't understand, real estate agents don't understand, hell, even mortgage underwriters don't understand it. I get phone calls all the time from underwriters at other mortgage companies asking me questions on the VA loan. So this topic, thanks for tuning in, by the way, like, share, subscribe, all that stuff. Um, this topic is going to be underwriting VA loans. Now, underwriting VA loans is a completely different mindset. So stay tuned. I'm going to talk about that. This one may be a little more lengthy because there's a lot of content here and it's very important. So there's so much that I've got to do I'm going to try to do a screen share and show you this slideshow real quick. So if I can do this, we're going to dive right in. Okay, so first we're going to talk about underwriting VA loans. The first thing that you need to know is that all lenders, we use an automated underwriting system. We call it AUS. It either goes through Fannie Mae or Freddie Mac. Fannie Mae's is DU and Freddie Mac's is called LP. The automated underwriting system likes credit scores above a 640. Although it's not necessarily, doesn't mean you're not going to get a loan if you're under a 640, but anything under a 640, it begins to scrutinize. So your loan, either if it goes through the automated underwriting system, it basically calculates, it looks at your loan application, all the information that you gave us, and credit scores and debt to income ratios and debts and lates on your credit and your income and how much money you've got in the bank. It looks at all these factors, runs this algorithm, and then kicks out an answer. Either you're approved or you're not approved. And if we get an approval through that automated underwriting system, your loan's going to close, no questions asked. It's going to be super easy, smooth process. However, if your loan is not approved through the automated underwriting software, then it refers it to a manual underwrite. What that means is that an underwriter needs to manually review your loan application, all the documents that you provided, and determine if you're a satisfactory credit risk. So wanted to talk real quickly about manual underwritten loans and why they're complicated. Most lenders in the industry don't even fool with manual underwrites. They're too much risk. They're not sellable on the secondary market, which means that mortgage company is going to end up having to service that loan. Most companies don't like to service high risk loans. There are some that do, but it just puts an additional risk on the lender, which means the underwriter is going to look at it and they're going to scrutinize everything about it. That's all there is to it. They're going to add, the VA actually has additional restrictions and recommendations for the underwriters to follow when manually underwriting a loan. So you got to have strong compensating factors. My company, we're not afraid to do a manual underwrite on loans, and I've done so many of them in my past. I can tell you if you're going to be able to get a loan or not. Here's the things that you need to understand how you can get a VA loan. So first of all, let's understand the underwriting mindset. It's totally different than any other loan program out there, like conventional loans, FHA loans, any other type of loans. It basically, you just have to meet the guidelines. However, with the VA, their guidelines are kind of gray. They leave a lot of gray area for the lender to make their own decision. So the first thing that you need to understand about the VA loan is it's a benefit to the veteran. So it's something that they've earned and that they're entitled to. We, myself included, right? So the VA actually says this, that lenders are encouraged to make VA loans to all qualified veterans who qualify. So the underwriting standards are intended to provide guidance for lenders and underwriters as well. So the VA loans, the guidelines just kind of give you a parameter on how to do the loans. And they say, just kind of try to stay within here. And it gives a lot of gray area and it gives a lot of underwriter discretion. In fact, number 4 here, and I copied and pasted this directly from the VA guidelines. It says underwriter decisions must be based on sound application of underwriting standards, and underwriters are expected to use good judgment, flexibility in applying the guidelines. So when you start using terms like sound application, good judgment, flexibility, who defines sound application and good judgment? Well, it's really not defined. So they put it back on the lender. Let me explain to you this. I'm going to break it down Barney style how this works. Basically, the underwriter signs off on a loan and then we go have it insured with the VA. If the situation were to arise and you were to foreclose, or a veteran were to foreclose on their house, then the VA is going to come back to that lender and they're going to say, okay, why did you give this veteran a loan? And then the mortgage company then has to justify why we gave you a loan. So if it's easy to justify, and I'll define that here in just a minute, the next slide. But if it's easy to justify why I gave you a loan, we're putting you in a better position, and you're able to make those payments, it's not going to be an issue. So the VA, basically, that's where the VA is different. The underwriters are looking at it from the mindset of, if you were to foreclose and you were to come back, can we document that we put you in a better position? So number 5, by law, the VA may only guarantee a loan when it is possible to determine that the veteran is a satisfactory credit risk and has and the income, basically you can make your payments. All right, so this is directly from the VA. You got to be a satisfactory credit risk that you're not going to just bounce on your mortgage and screw everybody, and you got to have enough money to be able to repay the loan. Simple enough, right? All right, so the VA makes us document how we do it. They give the underwriters a wide array of how to document that. And the 2 main things that you need to understand about a VA loan, this goes for underwriters too. This is the part that I try to help underwriters understand. Don't take my word for it. Jump into the VA guidelines and see it for yourself. Number 1, we must be putting the veteran in a better position. Let's talk about that real quick. If you come to me and you're currently paying $1,000 a month in rent, and you want to go buy a house that's going to cost $1,700 a month, so you're going up $700 a month. You got a little bit of payment shock there. You don't have any money in the bank. For example, you're living check to check right now. Am I putting you in a better position by putting you in that house? Probably not. However, the reverse, think about it. If you're currently paying $1,700 a month, and when you find a house that's only $1,500 a month, and you're saving a couple $100 every month, and you got a couple grand in your savings account, absolutely, I can justify that all day long, that I'm putting you in a better position, right? So some things that demonstrate that you're a good credit risk are having money in the bank. Money in the bank, first and foremost, is probably one of the biggest ones. Everybody has issues with their credit at some point in their life, especially getting out of the military, because you guys know you take a big drop in income, and your credit usually suffers as a result. But demonstrating that you have the ability to save money usually is an indicating factor that you're back on your feet and you're stable financially. So if you're stable financially, you got a little bit of money in the bank. The VA actually clarifies in their guidelines. They say if you have 3 months of reserves, which means you've got a reserve is a month worth of your mortgage payment. So for example, if your mortgage payment is $1,500 a month and you have $4,500 in the bank, that's 3 months to fall back on. The VA considers you a very low credit risk, and that's actually a really good compensating factor. So I can go to my underwriter and say, hey, this guy had some bad stuff happen in the past. However, he's back on his feet now. The bleeding has stopped. He's solid financially. He's still working on his credit. It takes some time to get that back, but he's saving some money in the bank, and we're putting him in a better position. Boom. I'm going to do that loan all day long, whether if it's approved through the automated underwriting system or not. I'm going to go sit down with my underwriter next door. We're going to talk through it. I'm going to get a strong commitment before I pre-approve that loan. Okay. Number 2 main thing you've got to understand. Number 1 was got to be putting you in a better position. Number 2, a veteran must demonstrate the ability to repay that loan. So I've got to be able to verify and document your income. Your income's got to be stable and likely to continue. So if your income's unstable or not likely to continue, the VA says your income has to be likely to continue for at least 3 years. So if you have temporary income, not going to be able to count that. Or if you're getting, well, I'll talk more about the income in 2 chapters from now, but I appreciate you guys tuning in. Hopefully I've helped you to understand the underwriting mindset that goes on and what takes the qualifications for a VA loan. So I'm super passionate about helping veterans and about educating. If you guys have any questions anytime, best way to reach me is call or email, or the best way to do is set an appointment for a free 15-minute consult where I talk about your scenario. I appreciate you guys tuning in.